Welcome back to the deep dive. If you've ever wondered how a business selling high-value items like, say, jewelry, manages to scale up, especially digitally first, in a really volatile environment, well, you're in the right place. Today, we're taking a close look at Bluestone Jewellery Lifestyle Ltd. Specifically, their Q2 and half-year FY26 results, which just came out, covering the period ending September 30th, 2025. It's a really interesting one because it's their first full quarter as a public company after their IPO.
That's exactly right. And for this, we're digging into their regulatory filings, the unaudited financials, both standalone and consolidated, and, crucially, what management said on their earnings call. We're essentially watching a major growth story unfold here.
Yeah, our mission today is pretty clear. How did Bluestone handle that wild gold price volatility right after going public? We need to get past just the surface level accounting, figure out what's really driving their revenue, understand that huge jump in profit, and see if their whole digital first omnichannel thing is actually, working. And just to set the scene, here's a number that jumped out at me. Standalone adjusted EBITDA for Q2 FY26 was INR 714 million. That's up over 1,300% year on year.
Wow.
Yeah, 1,300%, not a typo. When you see a number like that, you know something pretty fundamental has shifted in how the business operates.
Okay.
So let's start unpacking that top line first. Revenue. Standalone revenues hit a record. INR 5,131 million. That's over 5 billion rupees for the quarter. Pretty strong growth, 37.4% year on year.
It is strong. And what makes it even more impressive is the backdrop. Management kept calling the gold price situation dynamic. They actually said demand was, quote, mixed in September. It apparently softened quite a bit early in the month when prices spiked, but then finished with a very strong festive finish.
Right, so it wasn't just smooth sailing through the whole quarter. Which brings us to same-store sales growth, SSSG. That's always key, isn't it?
Always.
For Q2, SSSG was 11.1% year on year. Now, 11.1% sounds decent, but you really need the context here.
Exactly. You absolutely have to compare it to last year. Q2 FY25 saw SSSG of, wait for it, 43.8% year on year.
Whoa.
Yeah, that was massive. Driven by a custom duty cut that sort of released all this pent-up demand across the industry. So managing 11.1% growth on top of that incredibly high base, well, it shows real resilience. And maybe that consumers are starting to trust the brand more consistently.
But was that 11.1% growth just because gold cost more, or were they actually selling more pieces?
Okay.
Volume versus value, right?
That's a great question. Because when prices jump around, people do tend to hesitate. Management even said customers hold back their purchases, hoping the price will drop. So that definitely hits volume in the short term. The fact they still grew, and especially rebounded late in the quarter, suggests it was a mix. Yes, higher prices helped the top line, but people did come back to buy, especially for the festive season. It implies customers still see gold as, well, essential. They navigated that price shock.
Okay, so strong revenue despite the bumps, that must feed the bottom line. But that 1,300% EBITDA number, it sounds almost too good to be true without looking closer.
You're right to be cautious. Especially in jewelry, headline EBITDA can be misleading. The big variable is always the gold price, changing the value of their inventory on paper. That creates an inventory gain or loss. It's just a mark-to-market thing. So to see how the actual operations are doing, the stores, the manufacturing, you have to strip that out. We look at something called pre-ind as EBITDA, excluding any inventory gain. That gives you the core picture.
Right. Isolates the operational performance. So what did that metric show?
A huge turnaround. For Q2 FY26, this core pre-ind as EBITDA was positive INR 160 million. That's a 3.1% margin. Now compare that to Q2 last year. They had a loss of INR 211 million, which was a negative 5.6% margin.
Wow, that's a massive swing, over 870 basis points.
Exactly. That swing shows the operating leverage kicking in. Their costs, like stores and corporate overhead, are mostly fixed. So as revenue grows, more of it drops to the bottom line. This isn't just paper profit, it's real efficiency improvement.
And I think the cash pad number confirms that, right? They actually generated positive cash pad of INR 61 million this quarter. Compare that to losing INR 536 million in cash last year.
Yes, the positive cash pad is the clincher. It shows the actual cash left after all expenses, ignoring non-cash stuff like ESOPs or depreciation. Moving from burning that much cash to actually generating cash, that's the sign of a business successfully shifting gears from pure growth to profitable scale.
And this timing lines up perfectly with their IPO, which finished during the quarter. They listed August 19th, 2025. Raised a lot of money, over 15 billion rupees total, with 8.2 billion in fresh capital, mostly flagged for working capital needs.
That capital wasn't just financial engineering, it was fuel. It gave them the confidence and the funds to handle that big inventory build we'll talk about and keep rolling out stores, which takes us straight to their physical strategy.
Let's look at the stores. End of September, they had 311 stores, 127 cities. That's 19 new stores open just in Q2.
And 78 stores added over the whole year.
Yeah, 78 year on year. That's relentless expansion. It's the heavy lifting behind the whole strategy.
It really is. And it powers their omnichannel model. Jewelry's high touch, right? People browse online, sure, but often they need to see it, feel it, that offline touch point before spending serious money. Those 311 stores are the bridge.
And it looks like customers are using that bridge more and more. Their total customer base is up 31% year on year, nearly 860,000 people. But here's the loyalty stat. Repeat revenue ratio was 51.4%, half their revenue from repeat customers.
That's incredibly powerful in this category. Trust builds loyalty, and loyalty builds bigger baskets. You see it in the average order value, the AOV. It jumped 33% year on year to almost INR 60,000.
60,000 rupees per order on average.
Right. Management said that as people get comfortable with the Bluestone brand, the quality, the designs, they tend to shop more and higher value. So good upselling and cross-selling happening there.
But even loyal customers react to prices. With gold being so high and volatile, the mix changed, didn't it? Studded jewelry revenue, usually higher margin, fell to 62% of the total, down from 67% last year.
Yeah, people lean towards plain gold or maybe designs that just hit a certain price point they were comfortable with, given the gold cost.
That could have really hurt margins.
It could have, but this is where that scale and efficiency pay off. Even with less studded jewelry in the mix, their core contribution margin, again, ignoring inventory gains, held steady at 31.8%. They managed to fight off that mix headwind through better scale and manufacturing efficiency.
Okay, now let's tackle something tricky from the earnings call. We talked about the great year-on-year profit jump, but sequentially, quarter-on-quarter, the core pre-Ind AS EBITDA margin actually dropped from 4.7% in Q1 down to 3.1% in Q2, even though revenue went up. Why?
Yeah, that looks counterintuitive at first glance. But it wasn't a sign of underlying weakness. It was mostly down to deliberate spending choices tied to the festive season timing. The pressure came from higher advertising and marketing, or A&P, spend in Q2 compared to Q1. Two main things drove that. First, the timing of festivals. Navratri came earlier this year, so marketing spend that usually hits Q3 got pulled into Q2. Management estimated that shift alone cost about 50 to 100 basis points on the Q2 margin.
Okay, so just a timing shift. And the second driver, that sounds like it was a reaction to the gold prices.
Exactly. It was their big gold upgrade promotion. Because gold prices were high, more people wanted to exchange old gold. Bluestone apparently had a really attractive exchange offer, much better than competitors, they said. So more people used it, which drove up the promotional costs in Q2. Expensive maybe, but it likely drove traffic and helped that AOV.
Right, makes sense. And speaking of costs and needing cash, let's talk inventory. Levels jumped 13% just from Q1 to Q2, reaching over 19.6 billion rupees. That's a massive amount of stock to build right after an IPO.
Yeah.
What was the thinking?
It was definitely a conscious decision enabled by that IPO cash. Three reasons, really. One, they needed stock for those 19 new stores they just opened. Two, the higher gold price itself inflates the value of existing inventory on the books, that mark-to-market effect again.
Right.
And three, and this is crucial, they needed to build inventory early for Q3. Q3 has Diwali. It's historically their strongest quarter. You have to stock up well in advance. So they were loading up for the big festive push.
Got it. And one last bit of context. How do they see themselves in the market? Who are their peers?
They clearly benchmark themselves against Carrot Lane, which is part of Titan. It's not just about size, it's the model. Both Bluestone and Carrot Lane are seen as digital-first, omni-channel, focused on design, quite different from the more traditional legacy jewelers.
Okay, so pulling this all together, what's the main takeaway for someone trying to understand Bluestone right now?
I think the core story from Q2 is seeing that strategic transition really happen. They're moving beyond just spending heavily to open stores everywhere into a phase where those stores are becoming productive. The fixed costs are largely in place, so new revenue generates profit much more efficiently. That operating leverage is real, and the swing to positive cash PAT proves it.
And management seems pretty upfront about how they want people to measure them, right?
Yeah.
They mentioned adjusted EBITDA and cash PAT for the short term, but pointed towards something else longer term.
Yes. They specifically said over the medium term, core store ROCE profile at scale should reflect through at corporate level ROCE and ROE.
RC being return on capital employed, ROE, return on equity.
Exactly. They're basically saying, look, we're still spending on growth, so corporate profits might lag, but focus on how profitable each individual store is becoming its ROCE. Trust that as we slow down the new store openings, that store-level efficiency will flow through to the overall company's returns.
That leads perfectly into our final thought, something for you listening to mull over. Given gold prices are likely to stay volatile, and we saw customers shift away from higher margin studded items this quarter, how will that play out next quarter?
Right. Can their scale and manufacturing efficiencies keep offsetting a potentially lower margin product mix if people keep favoring plain gold? Or do they need the studded sales to rebound to keep driving those core margin improvements?
That tension between scale efficiency and product mix.
Right.
That feels like the key thing to watch.
Definitely the next chapter in their story.
We'll leave you with that thought. Thanks for joining us for this deep dive into Bluestone's latest results.